If you're already trading ICT concepts, order blocks, fair value gaps, liquidity sweeps, then you already have most of what you need to become a profitable trader. But what you're missing is a true understanding of higher time frame context, and specifically the phase of price that we're in. Is price accumulating? Is it manipulating? Is it distributing? This is going to turn you into a very profitable and consistent trader. So let me show you exactly how to get into high probability swing trades like this 2-hour short on EURCAD. So this works across time frames. Price is fractal, but for the purpose of this example, I'm going to use 12-hour price action. And I'm going to pair this price action with weekly, 2-weekly, and monthly candle behavior to truly understand what's going on. Because the truth is, one time frame, we can mark this up all day, but we'll get very little from it because in isolation, it means absolutely nothing. But everything changes when we do one thing. We overlay a higher time frame context. So this is the weekly time frame sitting behind 12-hour execution. So what do we see here? Well, the 12-hour time frame has shifted bullish into what? A previous weekly candle. So we see here that we have this candle range. This was a bullish candle. Price traded into the high and then closed inside the previous weekly range. So this confirms we have active first accumulation and then manipulation. This is a liquidity sweep. This is a turtle soup, whatever you want to call it. We are raiding the external range liquidity at these highs. And by closing inside the previous range, we are exposing a higher time frame target for price, which is the low of the accumulation candle. Accumulation, manipulation. So when we come into this week, we have everything we need to take a short. Let's look at what the monthly candle is doing. Okay, on the monthly time frame, we are coming off a bearish candle. This candle closed well below the previous monthly candle range. So when price liquidates the previous weekly candle, yes, we have an intermediate time frame target, but we are also looking for monthly continuations to where? The previous low of the monthly candle. So we have two targets for price. So I can take away the monthly, I'll just look at the weekly. So we're going to manipulate and then distribute to the draw on liquidity. So then I can take away my weekly candle context and look at structure on my execution time frame. When this week opens, what do we have? We have price selling off, shifting bullish. There we get the last sell to buy. Price retraces in and then closes through the last order block. So we've had a true structure shift. Let's actually look at that. Here was the order block. So I'll mark that here. Price trades in, initially respects, and then dumps through the swing point, which is essentially here. So this was the displacement that went higher. Price created the order block, the sell to buy. We're expecting price to trade in and away. Instead, it just closes straight through the actual swing point, creating what? A new buy to sell, a bearish order block. So this now comes back to those ICT concepts. This is a visualization on the chart of orders being accumulated, price being pushed bullish in order to trap anyone getting long at this level. So when price trades in, we have everything now aligned to take a short. We have an order block, we have a manipulation, and we have two key draws on liquidity. And that's as easy as the entry is. You enter at the low of the order block, cover the newly created swing point. First target is a 1.43R, but the higher time frame draw on the monthly is bearish. So that's an easy 2.17R. And then if you just want to hold this, you eventually get a 3R trade. So that is how to use ICT concepts in line with higher time frame, accumulation, manipulation, distribution. Let's look at another example on USDJPY. So now we're looking at 2-week examples. So here's our 12-hour price action. Let's overlay the 2-week candle. price has run into the high of the previous candle range. So we had this bullish accumulation, price went higher, enticed more longs into the market, traded into the sell to buy, we get this fair value gap, price trades in, and then away, causing displacement to the downside. What are we left with here? So in terms of 12-hour structure, from a swing trading point of view, we have the last buy to sell. This is where the candle closes, new candle opens, initially continues bearish, then starts to retrace. We have a couple of different things here. So if I just bring this a bit bigger so we can see, we get a bearish fair value gap right here, the imbalance between candle 1 and candle 3. And then you see we also have a fair value gap right here. So we have 2 or 3 areas. We have the order block, which could be the draw. We have the initial fair value gap, and then we have the fair value gap that eventually causes the sell-off. Why did this fair value gap not get respected, but the second fair value gap did? The reason for this is if we look at the daily time frame, what we see is that, of course, price is completely fractal. So you see on the 12-hour time frame, when that fair value gap gets mitigated, a daily fair value gap is also created on the higher time frame. So when this candle opens, it first wants to mitigate the daily fair value gap. So that is why price continues bullish. So where's our entry? Well, it is very simple. It's from the daily fair value gap, and then we have 2 options. We can cover the swing point or the actual liquidation. Price is already manipulated above the previous candle range, so it has no reason to retrace further than this. Where's our draw on liquidity? It's the low of the accumulation candle. So we can mark that, and what happens? Price trades in, trades away. We get a second buy to sell, a new fair value gap right here, which price trades into and respects. And where does it draw immediately to? The low. That's a 2.57 hour trade. So this is combining 2 concepts, ICT concepts with higher time frame, accumulation, manipulation, and distribution. It is literally your map of the market and how you consistently get into high probability trades. Where this gets even more interesting is price throughout this retracement was bullish. So all you need to do as a scalper or someone looking for precision entries is wait for lower time frames, the 6 hour, the 4 hour, to confirm, and you have a much, much higher risk to reward trade by just trading the downswing from this specific daily fair value gap. I'm going to cover that alongside a lot more on future videos. But if you're interested in understanding truly how to swing trade and how to understand and read higher time frame AMD, then please subscribe to the channel. I have a 30 video 3-part series on exactly this, and it's completely free. So go and check it out, and I'll see you on the next one.